So what does it take to become a qualified home buyer? Well, there is a magic formula to that, and I wanted to tell you all about it. The first piece of the puzzle is going to be just getting with the banks, and they're going to want to see your work history and 2 years worth of your W-2s. If you are in freelance or you're self-employed, it does tend to get a little bit more complicated, but they still want to see verifiable income. It's still pretty much the same on the 2 years, but also they need to be able to verify that income as well, and they're going to go off of the net and not the gross. Steady income is number one. The second thing is going to be good credit, because good credit is essentially the bank's insurance policy on you that you're going to pay your mortgage every month. FHA is a 580, and then conventional is a 620 on credit score. So that's kind of their standard number that they consider good credit. Now, I have seen it go below that, and there are some lenders that are good at still getting that done, and that's making sure you get connected with the right person to make that happen. But if your credit is just really low and you're still ready to get in the market to buy a home, I would just recommend getting with someone to help you get that straight, because there actually are different programs and even different lenders can help you work on that to get your credit score where it needs to be, because there is a game plan sort of like put in place and kind of a coach, so to speak, to help you get your credit score back. Third thing is gonna be low debt. So banks, they know that we're all going to come to the table with different kinds of debt. They're going to basically do what they call their debt to income ratio. As a general rule, the lower your ratio is, the better. And if your ratio falls outside of their number, then there are a couple of things that you can do to help get that number up. Of course, the first thing is just paying down your debt. And then the second thing would just be to, make more money. That's number 3. Number 4 is substantial assets. The bank wants to know you have enough money in the bank to purchase this home. A lot of people think they only need the down payment and they only need the closing costs. It used to be you had to have 20% down, but loans are more flexible now and you can put as little as 5% down. But then in addition, you're still gonna need 2 to 3% of the loan value for closing costs. So definitely you need that, but then also you're gonna need money on top of that, because they wanna know in case of an emergency, something unexpected comes up, which we know that happens all the time, that you're still going to be able to make that loan payment each month. I would just aim to put away as much as possible, because this is definitely a situation where the more you have, the better. So if you have any questions, or if you're a buyer just trying to figure out how to get started on that, shoot me a DM and I would love to get you connected with a realtor and a lender to get you headed in the right direction.